What would you do if the IRS handed you a surprise $12,000 bill for earning just $5,400 too much? That's exactly what happened to one retired couple when their income crossed a single hidden line on the Affordable Care Act. Cross that line by even $1, and every repayment protection you thought you had simply disappears. I read the fine print so you don't have to. Millions of Americans on Marketplace health plans are sitting right beside this cliff in 2026, and most have no idea it's there. Today, I'll show you 3 moves. Check your exposure, update your income the instant it changes, and plan your taxable income to stay under the line. Here's the number that decides everything. Once your income hits 400% of the federal poverty level, you repay 100% of any excess subsidy you received, with no dollar cap at all, according to IRS Form 8962 rules for 2026. But here's the part nobody tells you. Below that line, the IRS caps your payback, and above it, the cap vanishes completely. 3 moves protect you from this trap. Check your cliff exposure, report income changes immediately, and plan your taxable income to land under the threshold. Each takes under 20 minutes, and everyone is free. Marketplace subsidies are paid in advance based on the income you estimate when you enroll. That's your Advance Premium Tax Credit, or APTC. At tax time, the IRS reconciles it on Form 8962 against your actual modified adjusted gross income from your return and your Form 1095-A. If you guessed too low, you got too much help, and now you owe the difference back. Under 400% of the poverty level, the IRS limits how much you repay. For a married couple in the top tier below the line, that cap is around $2,800. IRS Form 8962 cap schedules for 2026. But the moment your actual income reaches 400% or higher, that cap disappears. And a payback that would have been capped near $2,800 becomes $12,000 or more. Now, the second layer that magnified everything. During the pandemic, special rules capped marketplace premiums at about 8.5% of income and removed the hard cliff entirely, so higher earners still got help. Those enhanced subsidies expired at the end of 2025, and starting in 2026, the cliff is back. $1 over the line, and your premium tax credit drops to 0. So the cost of inaction isn't a rounding error. CNBC reports that for 2026, couples earning above roughly $84,600 must repay any subsidies they received. And some older couples could see paybacks around $20,000. CNBC, January 2026. An older couple losing subsidies faces unsubsidized premiums near $25,700 a year. ACA Case Study 2026. Money they'd have kept by managing income. Here's the belief that traps people. Many think the most they can ever repay is a couple $1,000s because the ACA has limits. The truth is, those caps only apply below 400% of the poverty level. At or above it, you repay 100% of the excess with no dollar limit, which in 2026 can mean $10,000 to $20,000 or more. IRS rules via 2026 ACA analyses. Put the 2 costs side by side. Crossing the cliff meant a $12,000 clawback, IRS Form 8962 recalculation, plus $18,704 in annual subsidy that simply vanished. ACA Case Study 2026. Combined, the avoidable 1-year hit came to nearly $28,000 more than a managed year. Meet Mark and Lisa, 63 and 61. A semi-retired couple living on consulting work and investment withdrawals. They told the marketplace they'd earn about $80,000 to keep their silver plan premiums affordable, with 4 years to go before they both reach Medicare. Here's what Mark and Lisa found at tax time. Discovery 1. A $12,000 clawback landed on their tax return. Form 8962 listed excess advance premium tax credit of about $12,000, added straight to what they owed, because their final income crossed 400% of the poverty level, IRS Form 8962. Had they stayed under the line, their cap would have limited repayment to around $2,800, an extra $9,200 purely for crossing the cliff. Discovery 2. They'd accidentally earned their way out of every subsidy. At a carefully managed income near the line, their combined unsubsidized premium of $25,728 would have dropped to about $7,000, with subsidies covering roughly $18,704. ACA Case Study 2026. But at $90,000, their true credit was zero. Total coverage plus payback pushed their real cost toward $37,000 for 1 year. 1. Discovery 3, the most stinging of all. A tiny income adjustment would have saved them 5 figures, cutting their taxable income by just about $5,400, taking Roth withdrawals instead of traditional or delaying one consulting invoice, would have kept them under the $84,600 limit, ACA Calculators 2026. That small move would have preserved the subsidy, erased the $12,000 payback, and kept their year out of the $30,000 range. Add it all up, and the single-year avoidable cost was about $27,900, $18,700 in lost subsidy, plus roughly $9,200 in extra payback above the cap. ACA Analyses 2026. That's the price of one line on a tax form, and it's the price you can plan around. So could this be you? You have marketplace coverage and your income sits near $84,600 as a couple. You don't actually know your projected income for this tax year, and you haven't updated healthcare.gov since picking up new consulting work or capital gains. If any of those ring true, the next 3 moves are exactly for you. These 3 moves matter because a single hour of planning can be worth more than $12,000 at tax time. And they cost you nothing. Together, they let you see the cliff coming, react the moment your income shifts, and steer your taxable income safely under the line. Let's walk through each one. Move 1 is to check your exposure. Log into your healthcare.gov account and open your current application to see the income you reported and your monthly subsidy. Then compare that to last year's AGI on Form 1040. And use the marketplace estimator to see where you land against the 2026 limits, about $62,600 for individuals and $84,600 for couples. Here's how. Open your application and note your reported income and monthly APTC. Compare it to your Form 1040 AGI adjusting for expected changes. Then run the estimator against the 400% line. Good looks like a projected income sitting safely below $84,600 with room to spare. Move 2 is to update your income the instant it changes. When a new contract or a big capital gain lands, go to the Report a Life Change section on healthcare.gov and raise your income estimate. Your subsidy for the remaining months shrinks right away, which means far less to reconcile and far less to repay when you file. Here's how. Gather your recent pay stubs, contracts, and expected investment income. Then select Report a Change in Income and enter the new estimate. Accept the revised subsidy amount. Good looks like a payback that, if any, stays inside the IRS cap instead of ballooning uncapped. Before I get to the last move, which is the most counterintuitive part of all this is the one that actually saves the 5 figures. Move 3 is tax planning to keep your income under the cliff. Estimate your total taxable income for the year. And if you're near $84,600 as a couple, shift withdrawals into Roth accounts, delay non-essential consulting income, or trim realized capital gains to drop below the line. Here's how. Project your income using last year's return as a template, then shift withdrawals to Roth or delay income if you're near the limit, and rerun the estimate before year-end to confirm you're under. Good looks like a final income comfortably below the cliff, keeping subsidies worth around $18,700 intact. If breakdowns like this are useful, subscribe. The next one's already coming. This isn't a permanent rule. It's a policy that just swung back. Back in 2014, the IRS launched Form 8962 and the repayment caps tied to poverty level ratios. From 2021 through 2025, enhanced subsidies capped premiums near 8.5% of income and removed the cliff entirely. 2021 relief laws. Then in 2026, the cliff returned. Cross 400%, and you repay every dollar of excess, with experts warning of $10,000 to $20,000 bills. CNBC, January 2026. Once you've acted, verify it worked. You should see a lower monthly subsidy reflected in your healthcare.gov account. Confirm your projected income on paper sits below your poverty level limit. And if your income spikes again later in the year, report it that same month rather than waiting for tax season. Everything here is drawn from the IRS Form 8962 rules. CNBC's 2026 subsidy cliff reporting, the AJMC repayment analysis, and published ACA case studies. All the links are in the description below, so you can check the current thresholds yourself. Remember, this is general information, not personal tax advice. So now you know the 400% cliff, the uncapped clawback, and the 3 moves that keep your subsidies safe. Next, I'm covering the Medicare enrollment trap that can quietly double your Part B premium for the rest of your life. A mistake people make in their very first sign-up window. It's a small timing detail that costs some retirees thousands every single year, and almost nobody sees it coming. If you want to catch that one, subscribe now so you don't miss it when it lands.